You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. With so much attention given to the Fed's short-term interest rate policy, it can be easy to overlook the Fed's balance sheet management. Early pandemic quantitative easing, meant to ease financial conditions through purchases of treasuries and mortgage-backed securities, transitioned into quantitative tightening last year. On today's episode, we talk with Walt Schmidt of FHN Financial, who puts mortgage-backed securities, or MBS, into the context of the Fed's balance sheet at this point in its tightening cycle. Stay tuned. Coming up soon, our interview with Walt Schmidt, Senior Vice President and Manager of Mortgage Strategies with FHN Financial. But first, a quick market update. The July Consumer Price Index came in mostly as expected, the second consecutive month of encouraging inflation data. Both the headline series and core series increased 0.2%. This followed the July employment report last week that showed slowing payrolls growth, giving investors growing confidence in the probability of a so-called soft landing. There are still upside risks to inflation in the months ahead, especially with rising energy prices, but this report was definitely good news. The last few weeks, we've seen strong data cause a bigger reaction at the longer end of the Treasury yield curve than the short end. One reading of this is that investors are much less worried that solid economic growth will lead to additional Fed tightening. Markets are currently showing about a 25% probability the Fed hikes at least another 25 basis points this year, with a firm expectation the FOMC will leave rates unchanged at the September meeting. Treasury's quarterly refunding announcement last week showed an increase in coupon securities, mostly as expected. The announcement reinforced some upward momentum in Treasury yields, especially after the Bank of Japan felt the need to intervene again after modifying its ultra-dovish yield curve control policy. The initial Treasury auctions this week for 3-year notes and 10-year notes showed solidly sufficient demand to absorb the new issuance. The 30-year auction on Thursday, however, was a little weaker. Moody's downgraded the ratings for 10 banks earlier this week, citing higher funding costs, risks from commercial real estate exposure, and regulatory capital issues. Fitch also surprised market analysts by downgrading the federal government to AA+. The downgrades provided little new information markets didn't already know, but when it comes to the Moody's downgrades, the sentiment definitely added to lingering fears that banks are still at risk following March bank tensions. That's all for the market update this time. Now, our interview with Walt Schmidt. Our guest today is Walt Schmidt, Senior Vice President, Manager of Mortgage Strategies with FHN Financial. Walt, thanks for coming on the podcast.
Very happy to do it, Will. Good to talk to you today.
The topic today is mortgage-backed securities, but specifically how they fit into the Fed's balance sheet and how to understand MBS as the Fed nears the end of its tightening cycle. But I want to start by taking a 10,000-foot view of the subject. I mean totally square one. So Walt, what is a mortgage-backed security?
So mortgage-backed security is simply a pool of 1 to 4 family first lien mortgage loans that are guaranteed, or the principal and interest payments of those are guaranteed by one of 3 government entities, or 2 of them are quasi-government entities. One's an actual part of the government's balance sheet. So those would be Ginnie Mae, which is a part of the U.S. government, and then Fannie Mae and Freddie Mac, which are known as government-sponsored entities. They're not technically on the government's balance sheet, but they enjoy a very large degree of support from the federal government and are thought of by the market to have no credit risk or very little credit risk. And so these mortgage loans are pooled into these mortgage-backed securities. So it would just be sort of the other side of anyone who's taken out a mortgage loan for their home. If they have a 30-year fixed-rate mortgage, their loan and many, many others up to 10 or more thousand loans in a single pool can exist, and so those are just pooled into these large securities. And again, the principal and interest payments are guaranteed to the investor by Fannie Mae, Freddie Mac, and Ginnie Mae.
Early on in the pandemic, the Fed used a variety of things in its toolkit to help stimulate the economy, and in the spring of 2020, really stop it, minimize the risks of the worst economic collapse happening. So it not only lowered its policy rate, the Fed funds rate, to essentially zero in order to make borrowing cheaper and encourage investment, but it also bought a lot of long-term securities in an effort to lower longer-term interest rates. And it's the second aspect that we'll be talking about today. So the Fed bought a lot of Treasury securities, but why did they decide to include mortgage-backed securities in this strategy?
Yes, that's a great question. To put it bluntly, early on in the early days of the pandemic, we remember those days well. And sort of mid March of 2020, mortgage-backed security spreads to Treasuries gapped much wider. They doubled. They got well over 200 basis points to Treasuries, and historically, anything wider than say 100 to 120 basis points has been seen as sort of wide or maybe starting to approach crisis levels, certainly once you get above 150 basis points. But I mean, there were certain sessions in mid-March of 2020 where we weren't even sure where the spreads were because we didn't know where the market was. To be quite frank, now we know that the real estate investment trust industry was in very dire straits. I don't know if the entire industry was insolvent from a mark-to-market standpoint, but it was very, very stressed at the time. A lot of bank portfolios were stressed as well, but mostly it was getting at toward the end of quarter end, and I think the REIT industry was a particular concern to the Fed, at least in the early days of the pandemic, and really caused them to include mortgage-backed securities in the in the early days of the quantitative easing that we saw, starting in really, I don't remember the exact date, but it was sometime around March 20th or maybe even a few days before that of 2020.
Fast forward to, I believe it was November 30th, 2021. This is where Fed Chair Jerome Powell testified to Congress, and it looked like the Fed was now going to shift away from thinking the economy needed this monetary accommodation to actually removing it. They thought the economy was overheating, and restoring price stability or fighting inflation was now its priority. So they started to kind of prime markets for raising their policy rate, which they eventually did in March. But they also decided to engage in quantitative tightening, which is managing the balance sheet, this kind of part of Treasury securities and MBS, in order to kind of also reverse that accommodation. In essence, it was to move in the opposite direction when they wanted to stimulate the economy. So how do they go about this process exactly in terms of communication, and what were the mechanics behind it?
The first thing to note about the transition is you're right. It was around the November 2021 timeframe when they started talking about it. I specifically remember Chair Powell talking about putting the word transitory away when talking about inflation. And so we all kind of knew that the stance of the Fed was about to change. The interesting thing about quantitative policies is that quantitative easing is much easier to do than quantitative tightening. Because for quantitative easing, the Fed is basically creating reserves. Some might argue out of thin air, but they're creating reserves and they're buying paper and they're controlling certain spreads in the market. Quantitative tightening involves some sort of combination of either allowing things to mature that are in the portfolio or to do outright sales. And the outright sales part is very, very difficult. We've argued all along, impossible, because of the size of the portfolio. The Fed's MBS portfolio had gotten over $2.5 trillion in asset size, unpaid balance, and that was well over 30% of the outstanding balance of the market. So the Fed, when it wanted to transition from QE to QT, I think found it quite difficult to be able to do anything other than simply allowing the portfolio to run off. Now, the good news with a mortgage-backed security is it is, as I said earlier, the other side of a mortgage loan, and everyone who has a mortgage loan understands that there's an element of principal and an element of interest that goes into the monthly payment. So even at very slow prepayment speeds where people are not refinancing, you still get this amortization, this natural amortization of MBS. And I think wisely the Fed has chosen that form of quantitative tightening, simply allowing the portfolio to run off because, again, quite frankly, their portfolio is much, much too large for them to entertain asset sales. There's really no one else in the globe in terms of a buyer type that's large enough to take on whatever sales they might want to entertain enacting.
I think there are a few stages then to put this into perspective, and of course, the great task on a podcast to describe a chart is never really very easy, but I'm going to try nonetheless. So in the first stage, when the Fed recognized that they wanted to remove accommodation from the economy, they started to taper their balance sheet. They were still buying securities, but at a slower pace. And then the kind of total value of securities on their balance sheet plateaued, and then it started to go down. And this is that rolling off of securities that you talked about. So this means that the specific point of MBS, there were securities that were going to mature, and the Fed decided instead of reinvesting that money into more mortgage-backed securities, they let them kind of just, disappear into thin air. They took that money. And were they doing that with all of the mortgage-backed securities that were maturing, or did they have, a certain amount that they were going to reinvest along the way?
Well, for a while, you're right. They were reinvesting. They were holding the balance sheet constant, and this is something they took out of their playbook from the long period of 2013 to 2018. So this is not the first time the Fed's engaged in QT. In fact, market participants might remember that the Fed held their balance sheet very constant from early 2014 into 2018. So for 4 years, the Fed didn't allow the portfolio to grow, but it also didn't allow it to shrink. It simply reinvested principal that was rolling off. They did that for a very short period of time in the sort of as we went from 21 to 22, but then very quickly they went into a mode of allowing first some of the portfolio to roll off. In other words, they did some reinvestment of what was rolling off, not everything that was rolling off, but they went down in $5 and $10 billion increments until finally, in sort of the mid 2022, they just stopped reinvesting altogether. So you're right; it does. The QT process, both in the 2014 through 2018 period, which took years, and then also in the 21 to 22 period, which only took a matter of months, had this two-step process where they would replace some of the pay downs for a while, and then finally got to the point where they just let it roll off. And we're in that phase now where they're simply letting it roll off. They're not reinvesting anything in the mortgage-backed securities market.
That kind of communication of really having forward guidance about what they're going to do with the balance sheet management with mortgage-backed securities, to me is in big contrast to their short-term interest rate policy. So there's a lot of mystery in the lead up to each Fed meeting about what the Fed is going to do with its interest rate decisions. Maybe not specifically in that meeting, but really when people are following the kind of questions about monetary policy, it's what is the Fed going to do with interest rates, over the next, let's say, 6 to 12 months. But this part of monetary policy, balance sheet management, quantitative tightening, whatever you want to call it, it's been somewhat in the background the past year. So why do you think the Fed has chosen to really take focus off of it? And how does this impact market pricing if it's a lot more predictable in how it's communicated ahead of time?
You want the real reason or the official reason? I think they're both tied together. The real reason is, and this is my personal opinion on this, I think the Fed's initial response to the pandemic lockdowns in 2020 was appropriate. I do think there were a lot of financial institutions, both, like I said, in the real estate investment trust sector, probably also in the banking sector, that were very, very distressed. And it was appropriate for them to buy paper, both in treasuries and mortgage-backed securities. I do feel like most of what they did in 2021 was too much. This was not a housing market crisis. The housing market had already started to recover in 21. They just simply bought too much paper. So the sort of, I guess, tongue-in-cheek response is they bought too much paper, so they don't want people to kind of think about that. The real response, though, is what I alluded to before, and that is their portfolio is simply too large. Whether you want to make the economic argument that they bought too much paper, or whether you just want to say, from a practical standpoint. And if anything, I think Chair Powell is a very practical person. He is not a PhD holder. He's not a theorist. He's a market participant. He has been for most of his career. And I think he understood early on in 2022 that too much talking about the balance sheet was bad for the real action of the Fed, and that is the rate, right? The policy rate that, as you alluded to, they've been focusing on. Chair Powell said early on that he wants it to be like paint drying in the background, something similar to what Chair Yellen had said too about the previous QT process. They don't want to talk about the balance sheet when they're in the QT process because, as I said, QT is so much more difficult for the Fed to execute than QE. QE, you just add to the balance sheet and you can manipulate market prices that way. QT is much more difficult just because of the size of the balance sheet. And I think that's why, they just want to keep it in the background. There were some members of the FOMC in early 22 that actually did talk about potential asset sales. And Chair Powell was always very, very much against that in his public remarks. I don't read the transcripts maybe as closely as I should. He probably also was against that in the meetings. Actually, the transcripts aren't out yet from those meetings. So it's something where Powell understood that the less said about the balance sheet in the QT process, the better.
There are a lot of ways that financial conditions can react based on forward guidance. And so the first time the Fed hiked rates this cycle was in March of 2022. But a lot of important market interest rates, especially mortgage rates, started to go up after that testimony the preceding November. When it comes to mortgage-backed securities in the context of the Fed's balance sheet, if quantitative tightening has been communicated in such a predictable way and people know the direction of it so well, has it already been priced into markets, or are there still impacts as time goes on?
I think most of it's been priced in, but I also believe that just the fact that you've got QT in the background and not a QE situation means that whatever your 10-year look-back view of spreads is, current spreads are pretty much wider than that, anywhere from a standard deviation to a standard deviation and a half, whether you're talking about OAS, whether you're talking about static spread, current coupon, some of these terms that we use in the MBS market. Depends on how you look at spreads, but we're pretty wide historically if you look at a 10-year look-back period. But for most of that 10-year look-back period, the Fed's been active in the market, right? Whether it was reinvesting cash flows, during the 14 through 18 period, whether it was buying a lot of paper in 20 and 21, the Fed has been very active through most of that period. So if you ask, is the market still feeling the effects of QT? I think so. We're not at the wides in spreads that we were in March after the sort of little banking, I don't know if you call it a banking crisis, but the banking concerns of March of this year. So we're not quite at those wides. We've narrowed in a little bit, but it seems to me that it would be very difficult for MBS spreads, for investment spreads, to get anywhere near the tights that we saw through most of the last 10 years. And I do think that spreads are they have a chance to tighten in from where they are now because they're still pretty wide. But I don't think that they're going to get much tighter than certainly the average of the last 10 years because I don't see the Fed buying MBS paper, at any time in the near future.
If that's the case, then with the connection between quantitative tightening and MBS, what do you think the main drivers of mortgage-backed securities will be in the next 6 to 12 months? Is it Fed policy, the housing market? What are going to be the most important things to look out for if really QT is largely priced into the market?
Well, it's all tied in together, right? And came out as the demand side of the market. So at the beginning of 2023, the Fed owned about a third of the market. Banks owned about a third of the market, and money managers own less than 10% of the market. And then others are in there. The foreign investors own quite a bit. They own about 12 or 13%. There's other investor types. If you add it all up, the market's dominated by the Fed and banks. Well, now 6 months later, the combination of the Fed and banks in the U.S. is less than 60%. So together they were almost 70% about 6 to 8 months ago. Now together they're less than 60%. And so some of these other, what the Fed would call in the flow of funds data, the household data, right, which includes money managers, insurance companies, and others, they own a higher percentage. And so going forward from here, we think the big sort of contributor to whether spreads will tighten from here or not will be, are banks going to get back in? Quite a few banks are starting to think about getting back into the market. They do still have very large mark-to-market losses in their portfolios, and certainly not every bank's going to be looking to get back in. But loan demand is starting to slow down. Deposits are starting to pick back up, at least for the large money center and many of the regional banks. We are fairly constructive on MBS spreads for the next 6 to at least 6 months, maybe 6 to 12 months, because we do think that there are more banks that are going to entertain getting back into the market. You have to remember that spreads have tightened in somewhat since March, but they're still more than a standard deviation wide based on a 10-year look back, and they're probably about a half a standard deviation wide based on a 20-year look back that includes the great financial crisis of 2008 and 2009. So spreads are still fairly generous. And the bank demand now, which has basically been non-existent for the last 6 months, may start to come back into the market. The other factor, which is a little more technical, we wrote about this in our second half year outlook that we just published a couple of weeks ago, and that's implied volatility. And that has a lot to do with a lot of different factors, probably beyond the scope of this podcast. But for those that care about that factor, if implied volatility continues to go down because the market gets more and more assurance about what the Fed's going to do, then spreads in general, they're just naturally going to narrow because for the same OAS, if volatility goes down, then regular static spreads will become narrower.
It sounds like there's a really interesting mixture, a lot of, a combination of dynamics there that are driving the mortgage-backed securities market in the next 6 to 12 months, whether it's the banking sector, how that plays out, Fed policy, really all of the components of the macro landscape. So do you feel that there is anything right now, let's say for the rest of this year, that investors aren't really giving enough focus on when it comes to MBS, or something that's underappreciated?
No, I think everything's in full view. The one interesting thing about the MBS market that's different now than it has been for really most of the last 10 years, and it's actually a positive for MBS, is the fact that there is a very large diversity of coupons that are available for investors to purchase or to participate in. A year and a half, 2 years ago, when the Fed was buying paper, a lot of paper every month, everyone kind of just relied on the Fed to keep spreads narrow, and everyone was sort of reaching for yield. But the problem was, well, there are quite a few problems with that, but one of the problems was the fact that there was the coupon stack was very narrow. So investors could choose from 1.5s, 2s, 2.5s, and 3s. You basically had 4 coupons from which you could choose. And for a lot of that period in 20 and 21, you only had 2, 3, and 4 points of dollar price differential between those coupons. Now you've got a market where you can buy 30-year 2s at almost 80 cents of the dollar. It's a little bit higher than that. Or you can buy 30-year 6.5s at a 102 dollar price. So you've got about 20 points worth of investment choices, and that gives investors a chance to make a view or express a view on interest rates, on shape of the yield curve, on implied volatility, on prepayments, on a lot of different factors. It really gives the MBS market a fuller sort of characteristic that allows investors to express more than one view. So there's the current coupon spread, there's middle coupons, there's lower coupons, and on a day-to-day basis, in terms of just daily performance, you could get a wide variety of performance metrics say, yesterday, for example, the lower coupons outperformed by a quarter point, but the current coupons basically performed in line with Treasury hedges. So that just gives you a good example of there's a lot of diversity across the coupon stack, which actually is a good thing, I think, for the market because it allows people to make different decisions.
Walt Schmidt, thank you very much for coming on the podcast.
Very good. Thanks for having me, Will. It was a pleasure.
That was Walt Schmidt, Senior Vice President and Manager of Mortgage Strategies with FHN Financial. One thing that really sticks in my mind from that interview was the asymmetry of risks between QE and QT. That is, the Fed's mission to stabilize the mortgage market through purchases of MBS is an easy decision in March 2020, but removing that accommodation is not always as smooth. Now that July CPI is in the books, the next big data release will be retail sales on Tuesday. The market consensus is for another strong month of spending, which would help reinforce the Atlanta Fed's most recent estimate for third quarter GDP to grow at an incredibly strong 4%. We'll be monitoring how the bond market reacts to any upside surprises. Specifically, if strong data causes little to no change at the short end of the yield curve, we can infer that markets don't connect economic strength with overheating that needs more Fed tightening, as has been the case for so much of the last 2 years. Also next week, the minutes from the Fed's July decision will be released on August 16th, which could provide more detail on the disagreements within the FOMC. Fed officials are scheduled to speak publicly the next couple weeks, adding color to how recent inflation data is helping shape the views of individual FOMC participants. The Jackson Hole Economic Symposium, which features not only Fed Chair Powell, but also the world's most powerful central bankers, will be held August 24th to 26th. The event is sure to give an interesting status check on global central bankers' progress in fighting pandemic inflation. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions, comments, or concerns. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. The views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.